is it possible to do a no-cost mortgage?
It is. However, there's always going to be costs involved with a mortgage. So when you hear a lender talking about a no-cost mortgage, what that really means is that the costs are going to get covered by somebody else. And in this case, it would be the lender, for example, is going to pay a credit to cover the closing costs. Right, so you're still going to have those same closing costs. People aren't going to work for free. You got to pay an underwriting fee to the lender. There's a couple of other small fees that go to the lender, and then you have title fees and those types of things. So there's always those costs involved. However, the way it works is you would then take a slightly higher interest rate that would provide a lender credit that would pay for those closing costs. So that would help you keep money in your pocket, improve your cash flow, but ultimately the borrower or the buyer is going to be the one paying the closing costs. It's just built in their interest rate, but their out of pocket would be a lot less at the closing table.
Whether I'm paying for them or I'm trying to roll them in, what are those costs that come involved?
So ideally, if you're working with a lender that's not charging too much, you are going to have an underwriting fee, and then there's like a tax service fee, and a flood cert fee. So there's a few of these fees that are given in any loan. Ideally, those costs are going to be around $1,100 to $1,200 total for your lending fees.
Okay.
From there, you have your title fees. So on a refinance, we can keep the title fees a lot lower. On a purchase, generally those title fees are going to be a bit higher, but you could be anywhere from $800 or $900 on a refinance to $1,500 to $1,800 or more on a purchase, depending on the purchase price, etc.
How much do closing costs vary between different lenders?
I've seen where our company or our lenders, we're looking at around $1,150 for lender fees, and then I've seen also other lenders where they're probably looking at around $1,600 to $1,800 for those exact same fees. Sometimes they'll throw a processing fee on top of that, which is another $500. Sometimes they'll charge for credit reports, such as I've seen fees as high as $100 for credit report fees, whereas our company, we don't charge for credit report fees. So you could see those fees vary on our end from maybe $1,100 upwards to over a couple thousand just for straight lending fees. We're not talking points for the rate or anything like that.
Okay. Speaking of points, what are points? And when does it make sense to pay points?
Points are basically, like if you looked at, let's say, a $300,000 loan amount. If you paid 1 point on that loan amount, that's 1% or $3,000.
Okay.
And what you're doing is you're saying, I'm going to pay this $3,000 to get a lower interest rate. Okay. So instead of maybe getting 3%, I'm going to get maybe 2.75 or 2.875 to and pay those points to get that lower rate. So basically, and you can pay partial points. It doesn't always have to be a full point. Okay. You can maybe pay a half a point to get that rate a little bit lower.
When I'm paying points, I'm reducing my monthly payment as I'm making that mortgage payment.
That's the purpose, sure, because you are you're lowering that interest rate by paying the points, which is going to reflect in your lower monthly payment. So that's where points come into play. Now the question is, should you pay points or not?
Right. Okay. And should I pay points?
You're supposed to be asking questions, right? So,
right. So should I be paying? How do I figure out if that's actually a strategy for me?
So what I usually do with borrowers is we'll sit down and take a look at what's my interest rate without points, and then if I take it down to the next lower eighth, for example, how many points does that cost? Or maybe a quarter, how much does that cost? Okay. And we'll look at the difference in monthly payment. Basically, you divide the points that you're paying by the difference in the monthly payment, right? So if you're saving 25 bucks, you take $1,000 in points divided by 25, and that's going to tell you what your break-even point is for paying those points. So am I going to have to wait 3 years before I'm breaking even, 5 years, 8 years, and then it comes back to how long do you really think you'll be in that property. Right. And sometimes, as you're moving away from the market rate, the points are less to get your rate a little lower, but if you're really trying to get it a lot lower, the points become a lot more expensive. So it's really not only a matter of, it really just comes back to the break even, and you're going to maybe want to lower that rate an eighth or a quarter if it makes sense. But when you really start trying to buy it down a lot more away from the market rate, it gets very expensive.